My friends, let me tell you something that might sting a little, but needs to be said. Most investors are defeated before they buy their first share of stock, not because they lack intelligence, not because they lack capital, but because they come to the market with the wrong mental framework entirely. I've watched this tragedy unfold for decades. Bright men and women, successful in their professions, enter the stock market and proceed to violate every principle of sound investment. They transform themselves from rational human beings into emotional speculators within moments of opening a brokerage account. And the worst part? They don't even realize they've already lost the game. Today I want to explain why this happens, and more importantly, how you can avoid this fate. Because understanding where investors go wrong before they even start is the first step toward becoming a true investor rather than a speculator dressed in investor's clothing. The question we must answer is this: what are the fundamental errors in thinking, in preparation, and in temperament that doom investors from the very beginning? Let's examine this together piece by piece. The first and perhaps most catastrophic error occurs at the very foundation. Most people begin with an entirely wrong conception of what investing actually is. Ask the average person what it means to invest in stocks, and they'll tell you it means buying shares they hope will go up in price. This seems reasonable on the surface, doesn't it? But let me be clear, this is not investing. This is speculation. And there is nothing wrong with speculation if you know that's what you're doing and if you can afford to lose. But when you call speculation investing, you've poisoned the well from the start. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Everything else is speculation. Notice what's missing from that definition. There's no mention of hoping prices go up. There's no discussion of momentum, trends, or market sentiment. Instead, we focus on three things: thorough analysis, safety of principal, and adequate returns. Let me give you a concrete example. Suppose a man comes to you and says, "I'm buying shares in XYZ Corporation because it's up 50% this year and everyone's talking about it. I think it'll keep going up." Is this investing? No. He hasn't analyzed anything. He has no idea if his principal is safe. He doesn't know what an adequate return even looks like. He's simply gambling on momentum continuing. Now suppose another person says, "I'm buying shares in ABC Manufacturing. The company earns $5 per share consistently, pays a $3 dividend, has no debt, and the stock trades at $30. Based on my analysis of their competitive position and financial strength, I believe my principal is safe, and I'll earn approximately 10% annually between dividends and reasonable growth." This is investing. The tragedy is that most people never even ask themselves which category they fall into. They hear about investing, they open an account, and they immediately begin speculating without ever recognizing the distinction. They failed before they've started because they don't know what game they're playing. The second fatal error is beginning without a coherent set of investment principles. Most investors operate on whim, emotion, and tips rather than on carefully thought out policies. Think about any other serious endeavor in life. Would a lawyer go to court without understanding legal principles? Would an engineer design a bridge without reference to the principles of physics and material science? Of course not. Yet millions of people invest substantial portions of their wealth without any guiding principles whatsoever. I cannot emphasize this enough. You must have a philosophy of investment before you invest a single dollar. This philosophy should answer fundamental questions. Will you focus on safety or on spectacular gains? Will you buy based on asset values or earnings power? Will you diversify broadly or concentrate in your best ideas? What will you do when the market declines 30%? Without answers to these questions established in advance, you'll be blown about by every wind of opinion and every fluctuation in market prices. You'll buy high when enthusiasm reigns and sell low when despair sets in. You'll chase yesterday's winners and abandon sound businesses at exactly the wrong moment. Let me share a story. During the 1929 to 1932 period, I watched investors of substantial means completely destroyed, not because their businesses stopped earning money, Not because America stopped being productive, but because they had no principles to guide them through the storm. When prices fell, they had no framework for deciding whether to hold, buy more, or sell. So they did what felt right emotionally. They panicked and sold everything at the bottom. Meanwhile, those few investors who had established principles beforehand, who understood concepts like intrinsic value and margin of safety, were able to look past the market's temporary insanity. They bought wonderful businesses at absurd prices and laid the foundation for generational wealth. Your principles are your anchor in the storm. Without them, you're lost before you begin. Here's the third way investors fail before they start. They have no conception of intrinsic value. They look at stock prices, but they never look through the stock to the business underneath. A share of stock is not a ticker symbol. It's not a price on a screen that moves up and down. A share of stock is partial ownership in an actual business enterprise. It entitles you to a proportionate share of everything that business earns, from now until forever. This is intrinsic value, the true worth of your ownership stake. But most investors never calculate intrinsic value. They don't know how. They've never tried. Instead, they look at whether the price is going up or down, whether the stock is hot or cold, whether their brother-in-law is making money in it. These are all matters of price, not value. And price and value, while related over the long term, can diverge wildly in the short term. Let me illustrate this with a simple example. Suppose you have the opportunity to buy a small business in your town. This business consistently earns $100,000 per year in profit. It requires little capital investment to maintain. It has loyal customers and faces minimal competition. What's this business worth? Well, if you could buy it for $500,000, you'd earn 20% annually on your money. That's an excellent investment. If you had to pay $2 million, you'd earn only 5%, which might be adequate depending on alternatives. If someone wanted $5 million, you'd earn only 2%, and you'd be better off in treasury bonds. The business itself hasn't changed, but the investment value depends entirely on the price you pay. This is intrinsic value thinking. You estimate what the business is truly worth based on what it can earn for you as an owner. Then you compare that to the asking price. If the price is substantially below intrinsic value, you have a potential investment. If not, you walk away no matter how popular the stock might be. The investor who fails to grasp this concept is doomed. He'll overpay for popular stocks, he'll abandon cheap stocks because they're unloved, and he'll have no rational basis for any decision. He's operating in the dark, and he's lost before he begins. The fourth fatal error is beginning without understanding or demanding a margin of safety. This is perhaps the most important concept in all of investing, yet it's absent from most people's thinking entirely. The margin of safety is the difference between the price you pay and the intrinsic value you receive. It's your cushion against error, misfortune, and the inherent unpredictability of the future. Without it, you're one piece of bad luck away from permanent capital loss. Consider this principle as it applies in other areas of life. An engineer designing a bridge calculates the expected load and then builds the bridge to handle 5 times that load. Why? Because he knows his calculations might be off. Because he knows unexpected stresses might occur. Because he values safety above all else. This is margin of safety. In investing, demanding a margin of safety means refusing to pay anywhere near full intrinsic value. It means insisting on a substantial discount, perhaps 30%, 50%, or more, depending on the certainty of your analysis and the quality of the business. This discount protects you in multiple ways. First, it protects you against errors in your analysis. You might be wrong about future earnings. You might have missed a crucial risk. You might have been too optimistic. If you paid $50 for something worth $100, you have room for error. If you paid $100 for something you think is worth $100, a small error wipes you out. Second, it protects you against bad luck. Perhaps a key customer leaves. Perhaps a regulatory change hurts the business. Perhaps a recession reduces earnings temporarily. With a margin of safety, the business can suffer setbacks, and you'll still be fine because you bought it so cheaply. Third, and most importantly, it ensures that over time, through the mathematical probability of repeated bets with favorable odds, you'll compound your wealth safely and surely. But most investors buy stocks at or near what they consider fair value. Some even pay premium prices for growth or quality, or whatever story currently captures market fancy. They have no margin of safety whatsoever. And so when anything goes wrong, they suffer permanent capital loss. They failed before they started. Now we come to perhaps the most difficult problem of all. Investors fail before they start because they're emotionally unprepared for what the market will do to them. The stock market is a voting machine in the short run, but a weighing machine in the long run. In other words, prices fluctuate based on popularity, emotion, and crowd psychology day to day and month to month. But over years, prices eventually reflect the underlying business value. The problem is that most investors can't emotionally tolerate the short-run fluctuations. Let me be brutally honest with you. If you invest in stocks, you will see your portfolio decline 30%, 40%, perhaps even 50% at some point. This is not a possibility, this is a certainty. The question is not whether it will happen, but when, and whether you'll be prepared to respond rationally when it does. Most investors fail this test. When they see their portfolio cut in half, they panic. They can't sleep. Their spouse is worried. Their friends think they're fools. And so they sell, locking in permanent losses, often at the exact bottom. Why does this happen? Because they never prepared themselves emotionally for this inevitable experience. They imagined investing would be a smooth path to riches. They never contemplated the psychological difficulty of watching large paper losses accumulate. They never developed the emotional fortitude necessary to ignore market prices and focus on business values. The successful investor does something different. Before investing a single dollar, he says to himself, I know the market will someday offer me the opportunity to sell what I own for half of what I paid. When this happens, I will not panic. I will evaluate whether the businesses I own are still sound. If they are, I will hold. I may even buy more. The market's opinion of my holdings is irrelevant to their actual value. This mental preparation, established before you begin, is essential. Without it, you'll fail the inevitable test when it comes. My friends, we've covered 5 fundamental ways that investors fail before they even start. Wrong definition of investing, absence of principles, ignorance of intrinsic value, no margin of safety, and emotional unpreparedness. Notice what all of these have in common. They're not failures of execution. They're not about picking the wrong stop or timing the market poorly. They're failures that occur before a single investment is made. They're failures of preparation, of understanding, of mental framework. The good news is that these failures are entirely avoidable. You can educate yourself. You can develop a sound investment philosophy. You can learn to calculate intrinsic value. You can insist on a margin of safety. You can prepare yourself emotionally for the inevitable trials ahead. But you must do these things before you begin, not after. You cannot develop an investment philosophy in the middle of a market crash. You cannot learn to calculate value while staring at losses. You cannot build emotional discipline when panic is swirling around you. Do the work first. Understand what investing really means. Establish your principles. Learn the tools of analysis. Commit to your margin of safety. Prepare your mind and emotions for the journey ahead. Then, and only then, put your capital to work. Because the investor who fails before he starts is doomed. But the investor who prepares carefully, who thinks deeply, who operates on sound principles, has positioned himself for success regardless of what the market does tomorrow, next month, or next year. The choice, as always, is yours. Choose wisdom over impulse. Choose preparation over haste. Choose the path of the investor over the path of the speculator. That's how you avoid the fate of most investors. That's how you succeed where others fail. And that's how you build lasting wealth, safely, surely, and rationally. Thank you for listening, and remember, the intelligent investor is not the one who makes the most spectacular trades, but the one who avoids the most spectacular mistakes. Start right, and you'll be ahead of 90% of market participants before you bought your first share.